as Todd indicated, I want to spend just a few minutes looking at more short-term on the current market situation and some preliminary thoughts about 2015-16. I look at it from what I call a basic fundamental standpoint of expected supply and our pace of consumption, what that implies for year-ending stocks, and what that might mean for a marketing year average price this year and next year. I'm really not going to try to go any further than that. I do see that the USDA released its long-term projections yesterday, and if you're looking at those, you'll find my near-term forecast very friendly relative to theirs. So we'll see who's right eventually. But what I want to start with is just looking at the supply side of the corn market right now. And Scott alluded to some of these numbers. But if you want to look at the one factor that explains why prices have come down sharply in the corn market, it's purely a production phenomenon. The U.S. has had a record crop back-to-back 2013, 2014, and the crop size basically has exceeded our ability to consume corn, and so we're seeing a build in stocks and lower prices. For the current year, USDA's latest forecast released last month was for a crop of 14.4 billion bushels. I would remind you that they will release a final estimate of that crop size on January 12th. And I think that will be a little more important this year than most, because there's a little bit of confusion in the mind of the marketplace about where that number might come out. Typically, we would expect very little change from the November forecast to the final January estimate of production, usually focusing on the tweaks that might happen to the yield estimates state by state. This year, there's a little more interest in the acreage side of corn, and that stems from the fact that to this point, the acreage that has been reported by farmers to the FSA has been considerably less than the NASS estimate of planted acres this year. It's always less, and even in the final numbers, it's 2.5 to 3 million acres less than NASS, because not all farmers have to report to FSA, and so they represent about 97% of the acreage. But we can always kind of count on those numbers coming together, and so when we get the November or December FSA numbers, we think we have an awfully good forecast of what NASS is going to say in January. The December number this year on corn is still 4.6 million acres less than what NASS has estimated as planted acres in 2014. We think those numbers will come together. We don't know from which direction at this point, and the market has been anticipating that NASS will have to lower its estimate of planted and harvested acreage on the January 12th report. Without a change in the yield estimate, that could bring the production number down substantially from last year. Even a million acres would be 170 million bushels. That's significant in today's market. So what we don't also know, of course, is what might happen to the yield forecast, whether it would offset any change in the acreage or add to any change that would come from the acreage. So a long-winded way to say we have some unusual uncertainty at this stage of the marketing year on how big last year's crop was. It's big. The question is, how big was it actually? And that has some pretty important implications for year-ending stocks and price prospects for next year. For now, what we're doing is just trying to monitor our pace of consumption relative to the USDA projection, saying, are we on track? Are we using faster or slower? And in some categories of use, we have good real-time information about that. In other categories, we don't. So we're still without information in some categories. But kind of look at this for ethanol, exports, and feed use of corn, those three categories. This chart represents the history of corn used for ethanol, along with the projection for the current marketing year. It looks on this chart to be equal to last year. It's actually just marginally larger. We are through the first quarter of the marketing year. We don't know how much corn we used, but we do know how much ethanol was produced, so we can kind of back into the corn production number. We're running about 5% ahead of last year's production pace on ethanol through the first quarter. The first 2 weeks of December, we've seen record ethanol production. And if you annualize our current rate of ethanol production, it would certainly exceed by quite a margin what is being projected for the year. So we know that there will be some slowing. You kind of have to look at the details of the numbers because September production last year was very small. So you get a more normal production of ethanol this September. And so you get a pretty good percentage increase for the quarter that you know won't persist for the rest of the year. But we have had a little bit of concern about the impact of lower crude oil prices and gasoline prices on the potential for ethanol exports. Exports have become a fairly important part of the market. For this calendar year, we will probably export about 850 million gallons of ethanol. And we put that at risk a little bit if gasoline gets too cheap relative to ethanol, and that did happen recently, but as Scott indicated, those ratios are coming back into more normal relationship at this point with ethanol prices coming down sharply over the last 10 days. So I think certainly through the second quarter of the marketing year, ethanol production, ethanol exports are going to remain fairly stout. And I don't think that this projection for the year is in danger at all, and might even see that we come out just a little bit higher than what USDA is currently projecting. The other market where we have really good real-time information is in the export market. USDA projecting kind of a mid-range export year this year, 1.75 billion bushels. We get 2 reports on a weekly basis. Every Monday, we get the inspections report that says, okay, for the previous week, how much corn went out the door. And then on each Thursday, we get a report how big were new sales the previous week. What we see at this point is that the pace of shipments is quite slow. We're not shipping corn at the rate that we would need to reach the USDA projection. That needs to bounce up by about 50% from where we are right now. The argument has been that shipments have been slow because everything's been clogged up with soybeans going out the door. We've had some weeks of over 100 million bushels of soybeans, and the argument is we just don't have the capacity to do large quantities of both. If that is in fact the case, then as soybean exports slow down seasonally here, we should see the pace of exports pick up in the corn market. The really good news on the corn export scene is that we have large sales on the books. So we are selling corn at the pace needed to reach 1.75. At this juncture, it's just not going out the door. We need to see that happen. There's a couple reasons why I think exports are not expected to be even larger this year. One being that we are facing a little more competition in the feed market around the world, and that's coming from 2 sources. One, Black Sea region grain this year, and that's why everybody's interested in what Russia is going to do about exports or export embargoes. Will they lock their crop up or not? That would certainly be friendly for exports. The other area where we've seen some really low quality feed wheat coming out of Europe this year that's, I think, replaced corn in the market to some extent. And then thirdly, kind of a nuance again, is that because of China's position on taking some of our GMO corn, MIR 162, they have switched their purchases to sorghum, basically. So they're buying fairly large quantities of sorghum from the U.S., but not corn at this point. That appears to have changed recently. They've announced that they're now going to accept MIR 162. And I think immediately we did see some purchases of U.S. DDGs, which they've been a big market for. I think they eventually will come back to U.S. corn, but right now it looks like they're fully booked on sorghum for this year. We may not see an immediate impact there, but longer term, that's certainly good news if we can get that market back. So again, at the end of the day, you would say our pace of sales is really what you're interested in. And at this juncture, there's no reason to believe that we won't ship at least what the USDA has projected for the year. Where we don't have real-time information is in the livestock feed sector, and nobody measures corn consumption in this category. It is a residual calculation. We can look at it on a quarterly basis. When we get the USDA's quarterly stocks report, then we can backfill for the previous quarter a calculation of how much corn was fed. That report for December 1 stocks will also come out on January 12th. So it's a reason to put a second circle around that date on your calendar, I think. USDA is projecting a continued increase in feed and residual use of corn from the low mark in 2012, when we basically had limited supplies and very high prices, and looking at another 4 to 5% increase in feed use this year. We really need for that December 1 stocks report to confirm that we're doing that. We've got a couple things going for us, I think, that suggest that we are. One is that livestock numbers are on the rise. I kind of monitor that on a weekly and monthly basis, depending on the availability of USDA reports, but we see continued fairly large increases in broiler placements at this point. We're running about 3% above a year ago. Layer numbers are up, dairy cow numbers are up, hog numbers are expanding. We got, in fact, a few more cattle on feed than we had this time last year. That portion probably will not persist, but for right now, we're feeding a lot of livestock out there. The second thing we have going for us is the kind of the phenomenon that when you have a large crop and low prices, feed and residual use tends to be larger than you might forecast. Just on the other side of that is when you have a small crop and high prices, we don't use quite as much as you might expect if you just looked at livestock numbers per se. So this year with big crops, low prices, we're expecting to see confirmation of big disappearance in that stocks report. So that's why we also know that we occasionally get surprised by those reports. And there's been some fairly large surprises in recent years. And so until we see the number, our confidence will be a little bit on the low side, but our expectations are high at this point. I feel like those two reports, the production report and the stocks number, will really set the tone for the corn market going through the rest of the winter into the spring months. It's really going to dictate the market's expectation about how big year-ending stocks will be. Right now, those stocks are projected at right at 2 billion bushels, certainly larger than we've been in recent years. It's not what I would call really a burdensome carryover situation, but anytime we're above 1.5, the market feels pretty comfortable, pretty safe, that we've got some buffer against an upcoming production problem if that should happen. And it's difficult really for corn prices to move much higher when you have prospects for this kind of carryover. That's why January 12th, this projection could change by several hundred million bushels potentially. That would be pretty important for prices. I think if we're going to continue to see some of the strength that we've seen recently, we'll need to see a little bit of friendly numbers in those reports. For the year, as indicated, the midpoint of the USDA's projection is $3.50 corn. We've got numbers for basically the first quarter of the marketing year. Those are not weighted by sales yet, but we have the monthly average prices at which farmers have sold. And we've been right at to slightly above $3.50. And of course, we have seen the market rally since then with current prices closer to the $3.80 mark. And if we get neutral to supportive information on January 12th, I think we'll actually end up a bit higher than 3.5 for the year. I've been saying, maybe 370, maybe not a significant difference, but maybe about 20 cents higher than what USDA is currently projecting as their midpoint. That would certainly still be within the range that they're projecting. The question will quickly turn over the next few months. Corn prices will start to turn on how big is next year's corn crop. And that will start with a look at acreage. USDA will do their normal March survey. March 31, we'll get a prospective plantings report. Right now, USDA's long-term forecasts as well as market expectations would suggest a small decline in corn acres next year, citing lower margins, higher cost of producing corn relative to other crops. All those kind of factors are cited as suggesting corn acres will be down just a bit. The big issue, of course, will be yield. We look at a long-term trend, yield on corn. Linear trend still fits that pattern pretty closely. The last 55 years, corn yields have increased by an average of 1.8 bushels per acre per year. It doesn't seem to have changed in recent time period. A lot of variability around that trend. One place to start on a balance sheet for next year is to say, what if we have trend yield? That would be about 162 bushels, a full 10 or 11 bushels less than what we had this year. Just as a side note, if you look at this chart carefully, what you see, of course, is when you have really bad weather, yields tend to fall below trend by more than yields are above trend when you have good weather. That is, the negative differences are larger than the positive differences. So projecting a trend yield is different than projecting yield based on average weather. If you say, I want to project yield based on average weather, you would get a slightly higher yield forecast than just forecasting based on pure trend. So that leads me to the balance sheet. Some numbers that are hard to read, and maybe that's intentional here, but it says that the first column would just summarize this year's projected balance sheet, looking at acreage, yield, production, consumption by category, year-ending stocks, and a marketing year average price, and then carry that 1 year forward under the scenario of a number of ifs. One, if we reduce corn acres by 1 million, if yield drops to 164, which would be slightly above trend but would reflect average weather, we would have a crop that's nearly 1 billion bushels smaller than what we had this year. I'm not sure how much we can accelerate consumption. Ethanol market is plateauing to some extent. We might see some more modest expansion in livestock numbers. Those margins are dropping pretty rapidly. I think the biggest potential would be in the export market. I've talked a bit about China. We could get some of that market back. A little less competition from wheat. We could bump our total consumption up 150 million bushels next year. And now you're getting that year-ending stocks down to a much more manageable level. But what are the price implications of that kind of carryover? Seems to be a major difference in opinion. I'm suggesting that would point to an average corn price in the low to mid $4 range next year, $4.20 on this balance sheet. USDA, in their long-term projections released yesterday, they have a similar balance sheet, just slightly higher carryover stocks, and an average price 70 cents lower than what I show here. So there's some difference of opinion. Right now, as Scott indicated, the market for next year's corn, if you look at the structure of futures prices from December 2015 through summer of 2016, Central Illinois average cash price as reflected by that market is about 4.25 at this point. So this is not much different than what the market is saying at this point. If you believe USDA rather than these numbers, we can dismiss you to get your hedges on right now if you want to do that. But we'll see where this all unfolds. The critical question is, of course, how big is next year's crop going to be? And again, if you really know the answer to that, we can visit a bit after the meeting, but that's where it's all going to come down to at some point. But as Scott said, that's my story, and we'll stick to it. Just real quickly on soybeans, I spend most of my time on corn, but a lot of what I say carries over to soybeans, so we can move this through pretty quickly. Goes without saying, at this juncture, we had a big soybean crop last year. USDA will finalize that estimate on January 12th. I don't see the market really anticipating a significant change either direction from the current November forecast. We do have a little bit of the same acreage discrepancy on soybeans that we have on corn between FSA and NASS. The discrepancy is not quite as large. That'll have to get resolved at some point. The good news on soybeans, that somewhat different than corn, is that we are experiencing what some are calling phenomenal demand for soybeans this year. Partly in the domestic market, our rate of soybean crush is accelerating from last year. We got a very slow start in September because we ran out of old crop beans, and then the new harvest was delayed. Crushers couldn't find beans, but once we started harvesting, crush accelerated to record levels in October, and again, very large in November. I think this is going to be driven by soybean meal demand, domestic and export. So pretty comfortable that we will see this kind of increase. The big jump continues to be in the export market for soybeans, now projected at 1.76 billion bushels this year, and continues the phenomenal growth that we've experienced. The only time we have a downturn in exports is when we run out of soybeans, which we did in 11 and 12. And this is happening even with record production in South America. I mean, that's kind of the phenomenal thing in my mind, is back-to-back record crops and another one expected in calendar year 2015. Provides a lot of competition, but again, at the end of the day, China is absorbing these soybeans, and as long as they continue to do that, we can absorb fairly large world production. Even though we are experiencing that kind of demand, it's hard to overcome the size of last year's crop. We are seeing some build in inventory of soybeans. The average price now projected at $10 for this year. That's about where we've been for the first quarter. That's about where we are. I would guess that's about what we'll average for the year. What's going to happen next year? Less corn acres would point to more soybean acres. What kind of yield? Punch in a trend yield for soybeans, which would be about 3 bushels less than what we averaged this year. And then you can take that to your balance sheet. And so the 410 carryover this year, 410 million bushels, $10 average price. Bump acreage up 1 million next year, drop yield to 44.3. You get about a 200 million bushel reduction in production. We might bump consumption up a bit, 40 or 50 million bushels. The problem then is that you still get a further build in stocks of soybeans next year. I think it's going to be difficult to work our inventories of soybeans down very much. In contrast to what we're thinking on corn, we're probably going to be able to do that. And if this is close, then we would expect lower average prices next year than what we've experienced this year. I think many have their projections even lower than what I have here. This is about where the market is at this point. So in summary, we say we're probably going to continue below the long-term average prices that we expect, but would see corn prices moving back closer to that long-term average, and soybeans probably stable to a little weaker next year, and maybe $1 or more below that long-term average that Scott was talking about. So as Todd indicated, we will have a Q&A. If you have any questions along these lines that you want to submit, I certainly address those later in the day. Thank you very much.
Thank you, Darrel.